Hello, everybody. How you doing? I feel like you've had me this whole week. Are you bored yet? We got more. We got more. All of you, if you want to catch the replay from last night, everybody's, where's the replay from last night from Cash Collision? It's up top. It's up top. Right there in the chat, above in the chat. Now, what are we going to do today? We're going to talk about the VIX curve. What causes those cash collisions? First off, we're like, what is it and how does it work? Going to start with that. Then describe the three curves. And then we'll look at today. So you're going to get something today as a little goodie about what I think about the market is going into Friday. Potentially next week. And you should be able to walk away with some ideas on what this is all about. So the first thing is, I'm just going to tell you now, trading the VIX curve, I think, is the most important, right? Most important market indicator we get for free. That's the first thing. So why is that? Like, why is it? Because it's basically telling you, okay, what traders think. So at Option Pit, you come in and you say, Andrew, what do you think? Leisha, what do you think? Vaz, what do you think? Hans, Mark, what do you think? And we tell you. But if you're in here, you're a subscriber. If you want something for free, what do the other 1 million traders think? Okay, that is going to be here. Where are we? VIX, where's VIX Central here? What happened to VIX Central? It used to be such a useful website. All right. You can't reach it. I don't know why you can. You should be able to. I wish the SIBO would just take it over and make our lives easier. Here we go. Oh, I got Laurel Castleton down here, the U.S. head of equity portfolio, something or other. All right. It is free. Chemo, the Doge cuts. All right. Also, ask your questions. I'll answer them in the last 5 minutes. So the first part is why. Why does it look like this? And the reason is, I'm going to take a little picture of it for you, and you're going to get a little handout at the end. I believe Justin's been making nice little handouts and sending them out with the videos if you get the replay, if you want them. Nope, don't want that one. I want this one. Okay. What is it? It's been selected. So this curve is actually what I would call a contango curve. We'll hit that in a minute. The important parts right now, first off, what is it? Is first, this is a VIX future. Every one of these dots, most VIX curve are going to look the same, meaning you're going to have VIX is going to be some sort of line here, which is 1868. And this volatility curve into the future. So right now, VIX is 1868. Remember what VIX is for all your classes, right? VIX is the 30-day at the money volatility for the SPX. That's the S&P 500. And every day it moves forward. Every day it's always 30 days out. It doesn't exist. Only exists as an index. And for more on this, again, check out the cash collision replay up top. So, why is this interesting for us? Because this gives us a range. Okay. Basically, every 16 points in VIX is 1% per day in SPX. Every 16 points. So 32 points is 2%. 48 points is 3%. 12 points in VIX is 0.75% per day, which is roughly, somewhere between $3 and $4 a day. Or $30 and $40 a day SPX. So what you're getting here is an idea of traders are telling you. This is remember, this is all participants, all market participants. It's not just Mark and Andrew. This is the sum total of everybody's opinion in one place. That's why as a trader, I don't think you can ignore it. Sum total of all traders' opinions. Okay. Very few places where you can get that kind of information. And the SIBO provides it for nothing. Okay. So now the next part is that is the green line. The curve is now, we'll just call extrapolating what volatility is predicted to be in the future by the actual prices in the S&P 500. So the VIX curve, okay. So you have the VIX cash, green line. Okay. And then the blue line is the VIX curve. The VIX curve is the blue line. Okay. So what this is it's saying, hey, volatility is lower in the short term, but it's going to be higher in the long term. That's what contango means. Contango just means volatility is lower in the short term, but higher in the long term. Okay. Now, the second part of this is it also, in general, this is a bearish VIX curve, meaning this is bearish VIX in the short term. Now, there's a mathematical reason for this, but it's mostly because all the volatilities in the very short term, less than 30 days, are lower. So basically, all the stuff in the short term is lower and all the stuff in the long term is higher. So the market is looking for less action. Traders are saying, hey, there's going to be less action when you see a contango curve for this region. Who knew? A backward curve, and we'll take a picture of one, is exactly the opposite. Exactly the opposite. I'll take a picture of one, but I'll describe it here first. So volatility in the short term okay. So here what we have is volatility, right? Or VIX is higher in the short term, but lower in the long term. Now, the reason, again, for this is why. So let's take a look. There's time and sales issue in VIX. I was trying to buy more of my weekly profit cycles trade this morning, and they are not. All the replays are going to be over to the left, I believe. VIX. Here we go. All right, we're going to do a little walk down memory lane. Let me see. How about that April 4th day? Oh, look at that. One of these things is not like the other. Do. So when you see your backward curve and it looks like this, like look at where VIX is. Where's VIX? It's in the moon. And they're telling us down the road, the market is saying, hey, volatility is going to be lower, but right now it's crazy. And the reason this is actually bullish VIX in the short term. Because all the short-term volatilities are higher. So what you have is literally you can go in. So you're seeing what's going on today. And what is the market saying today? We're hovering right around like the halfway point in VIX. We're in contango, meaning volatility is expected to be lower in the short term, but higher in the long term. We're kind of sitting here waiting. We're waiting to see if that 18 volatility is going to be real. So if I give you this thing where 16 points in VIX is 1% per day, we're trading at 18. What's going on with our market? Are we moving? Are we moving to the VIX right now? Is the VIX an accurate predictor, at least for the first hour of the trading day, on what's happening today? Got a whole day left. But whatever news is out, it's not producing at least an 18 VIX, right? Does everybody see that? Like, so if we were down 1% at least, I would say, yeah, we're moving. But we only have a very tepid response. So the reality is VIX at an 18, almost 19. I'll ask you this another way. Will VIX stay at 1875 if SPX only moves 0.36% per day? Will VIX stay at 1875 if VIX only moves at 0.35% today? It will not. So part of trading these products is understanding the cause and effect. Like, as in, what's going to happen if the market does this? What do you do to respond? That's the cool part. That's the tradable part. That will be the cash collision part for all those that are interested. The market is setting up a certain way. And if SPY does not follow through, VIX is going to move. Right? So this is the thing that makes trading volatility interesting, is the inevitability of a move in volatility given a move in SPX. That's what makes this type of trading interesting. We can't stay at an 18 something if SPX is not moving enough. And then we set up our trades around that. So contango is a state of mind, is a market state of mind, is a relatively relaxed market state of mind. Whoops. Backwardation is a house on fire state of mind. So does everybody, hopefully now you understand the differences. Now, somewhere in between backward and flat, we have a relaxed state of mind. Oh my gosh, why can't I can't get that X in there. We have a relaxed state of mind. And then we have a backward state of mind. And then here at the end, we have a flat state of mind, which I think our last flat curve was, was it Friday? What is that? What does that look like to you? This is actually a kink from, I believe, Christmas. Does this look pretty flat to you? Meaning the volatilities, everything is basically the same. By the way, for weekly profit cycles, people, I've been trying to buy VIX puts all morning on the bid, and I cannot buy them. I'm trying to add more of a 197, and I cannot buy them. So I think, to me, that means I think vol's going lower today into the end of the week, but I could be totally wrong, but I'm still trying to buy them anyway. Okay. Flat. Okay, a flat curve. This is the classic. I don't know. I don't know which way the VIX will go. So generally, when you see this curve, you're going to move the straddle up or down in VIX, either up or down, generally by the near-term expiration. That's the little trade trick. At least the straddle. Okay. This is all like funky anomalies because of days, expiration days. Just let people know. All right, let's take a look. All right, so here's where we were, 21.95. This was Friday. So if we look at it, we go, okay, let's see how much we move from Friday. All right, so I'll go Friday was the 9th. And we'll look at our serial. And we were trading right around 22.5. The 22.5 puts were $1.70. Let's see where they got to, right? Because we traded lower. And the 22.5 puts are now $3 and oh wow, $3.85. They got as high as $4.75. Whoop, those are the 22.5. So I want the 22s. They got as high as $4.35. So the point I'm trying to make is VIX was there, curve was flat. VIX way overperformed the straddle. Way overperformed the straddle. Which is the idea, right? So from last week into this week, we wrote a lot of volatility puts, VIX puts, and several products. Wrote them lower until VIX basically stopped going down midweek. Look at this. We can't even get a rally out of it. I just want to see if I fill my puts. That's annoying. Anyway. All righty. So let's go back to our thing. So Nina, so let me rephrase that here. She's asking, when you say the VIX will move at least the straddle, you mean the straddle of the VIX on that day. So take the straddle of the near-term serial expiration. Near-term serial expiration. So that means is that would be, again, VIX straddle, not SPX. This is about VIX, not SPX moving. There's your hint. So that straddle was about $3. We moved, the puts went to $4.50. All right. So how will it improve my trading? Okay. I'd say it gives you a way to lean. Right? When I say lean, do we leave long or do we lean short? So like right now, I have to lean short volatile, even if volatility is going up. Now that doesn't mean I don't have some kind of protective options, but I still want to lean short, which is what I've got. All right, now I'll ask some questions. I'm just going to go from top to bottom. I answered Nina's question. Let me know, Nina, if I answer the question. Jim, does the curve go flat when going between contango and backwardation? Yes, it does. So it basically goes contango flat backward or backward flat contango, Jim. The one thing is it moves through the three curves, although it could skip flatness totally. It could skip flatness totally, meaning it can fly, it can die. Why did the SVIX stop decaying? Is it a failed product? SVIX stopped decaying because VIX never went into zone 1, Mike Hunt. Never went into zone 1 in 6 months. So SVIX only makes the big dough when it drops into zone 1. So I assume, since we've had so much time, again, in higher volatility, that eventually we start to, we've been in zone 3 and zone 4 for 6 months. So we just haven't, the market has been volatile. The news has been what it is. Right. I am going to go over the volatility products today in the RIP zone. So for all of you that are Rip Zone members, I'm going to go through each one of the ones we're trading and describe, how they work and when I like to use them. Let's see more questions. Why do traders tend to underestimate serial VIX straddle? So remember, the pricing you see, WA, is the pricing that is coming to them. So what happens is, generally when those straddles get compressed, traders start selling VIX options, compressing the volatility, and then we move down. Another hint about VIX in general, I'll give you hint number 2 here. Okay. VIX puts are almost always underpriced. Okay. How many people in here buy VIX puts because they think vol is going to go down? Mostly everybody's in here to do what? They're mostly in here to buy VIX calls because they're going to rip to the moon. Right? As you get a little smarter, you realize, wow, VIX puts can make me money. But people buy VIX calls because they want VIX to go from 15 to 50. As soon as that starts to go away, they start selling vol like crazy. Selling that upside VIX, and it just compresses everything, and the puts die faster than the calls. And the reason is what we call negative skew. If you notice here, all the volatilities on these little puts are very, very inexpensive. All right. All right, let's see here. Questions. Okay, question about backward contango. Bullish expectation signals when indices are in contango and VIX is in backwardation. While bearish. So Rick R. Contango is bullish SPX. Backwardation is bearish SPX. Those are the two. So if you think about it like that, if I say here, whoops, flat. Okay. So backward is generally bearish SPX. Bullish VIX. Okay. Again, this is how I'm going to lean. And here I'm going to say contango is bullish SPX, bearish. Right. That was for Rick Sar. And it's 10:30. Oh my gosh, already done. Already done. So again, real in summary, why is trading the VIX curve interesting? It's giving you information for free. Information for free. You have 3 basic curves: contango, backward, and flat. And each of those contain information about the future direction of VIX and the current direction of VIX. And you can ignore it at your peril, or you can join Cash Collision and learn how to trade it. What the heck? All right, guys. For all of you in Cash Collision, Rip Zone, I'll see you at 11 o'clock. Y'all have a good day. This handout will be available with the recording that Justin is going to make. All right, everybody. Have a good day.